Two Canadian companies, both publicly traded, both long-term wealth creators for patient investors. Shopify. In July 2026, Shopify trades at approximately 80 times its annual earnings. Investors are paying $80 for every $1 of profit Shopify currently generates. The company does not pay a dividend. It reinvests every dollar back into growth. Enbridge. Also in July 2026, Enbridge trades at approximately 17 times its annual earnings and pays a dividend yield of approximately 7%. Investors pay $17 for every $1 of profit Enbridge currently generates and receive 7 cents for every dollar invested every year just for holding the stock. Same Canadian stock market. Same July 2026. One company priced at 80 times earnings with no dividend. One company priced at 17 times earnings with a 7% yield. Why? And which one is the better investment? The answer to those two questions is the entire growth versus value debate, a debate that has occupied the world's greatest investors for nearly a century, a debate that split Warren Buffett and his mentor Benjamin Graham, a debate that produced dramatically different winners in different decades, and that is still very much alive in 2026. This video settles it, or at least gives you the framework to settle it for yourself. Before metrics and examples, the underlying logic. Because value investing and growth investing are not just different strategies. They reflect genuinely different beliefs about where investment returns come from. The value investing philosophy. Value investing begins with Benjamin Graham, the Columbia professor who wrote Security Analysis in 1934 and The Intelligent Investor in 1949, and who taught Warren Buffett. Graham's core belief: the stock market is not a perfectly rational pricing machine. It overreacts to bad news and underreacts to good news. In the short term, stock prices are driven by emotion, sentiment, and narrative. In the long term, prices converge on fundamental value, the actual earning power and asset value of the underlying business. The value investor's job: find companies where the market has overreacted to something, a bad quarter, an industry downturn, a headline that spooked investors, and the stock price is now below what the business is actually worth. Buy it. Wait for the market to recognize its mistake. Sell when the price reflects the real value. Graham famously called this the margin of safety, the gap between what you pay and what the business is worth. The wider the margin, the lower the risk, the higher the potential return. The growth investing philosophy. Growth investing begins with a different premise. The most important thing about a stock is not what the company earns today, but what it will earn in 5, 10, or 20 years from now. A company growing its earnings at 30% per year will double its earnings every 2.4 years. If you can identify that company early, before the market fully prices in the growth, you can buy it at what looks like a high P/E ratio today and hold it as the earnings grow into and beyond the current price. The growth investor is not paying 80 times earnings because they think 80 times is cheap. They are paying 80 times current earnings because they believe that in 5 years, the earnings will have grown so substantially that today's price will look like a bargain. Shopify at 80 times 2026 earnings might be Shopify at 20 times 2031 earnings if the business grows as expected. The key distinction: value investors buy companies that are cheap relative to what they are worth today. Growth investors buy companies that are cheap relative to what they will be worth in the future. Both are trying to buy a dollar for less than a dollar. They just disagree on which dollar to measure. Philosophy is abstract. The real world requires numbers. Here are the specific metrics investors use to identify value and growth stocks, and what each one actually tells you. Value stock metrics, price to earnings, PE ratio, the most fundamental valuation metric. A PE of 12 means investors paid $12 for every $1 of annual earnings. Value stocks typically trade at PE ratios of 8 times to 15 times, below the broad market average of approximately 20 times to 25 times for the S&P 500 or 15 times to 18 times for the TSX. Price to book, P/B ratio, compares the stock price to the company's net assets, total assets minus total liabilities. A P/B below 1.0 means the stock is trading below what the company would be worth if it were liquidated today. Classic Graham-style value stocks often trade below book value. Dividend yield. Value stocks frequently pay substantial dividends because they generate more current cash than they can profitably reinvest. Enbridge at 7%, Fortis at 4%, Royal Bank at 3.5%. The dividend is both a return in itself and a signal that the company generates real, distributable cash. Free cash flow yield. The amount of cash a company generates after capital expenditures expressed as a percentage of market cap. Value investors look for high free cash flow yields, companies generating substantial real cash relative to their market price. Growth stock metrics, revenue growth rate. Growth investors prioritize top-line expansion. A company growing revenue at 20% to 40% annually is growing its potential earnings base rapidly, even if current earnings are minimal. Earnings growth rate, the rate at which EPS is expanding. A growth investor wants to see consistent 20% to 30% plus annual earnings growth, and is willing to pay a premium multiple for it. Price to earnings to growth, PEG ratio. Developed by Peter Lynch. Divides the PE ratio by the earnings growth rate. A PEG below 1.0 suggests the stock may be undervalued relative to its growth. A PEG above 2.0 suggests the market is pricing in very optimistic growth assumptions. Shopify at 80 times PE with 25% earnings growth has a PEG of approximately 3.2, priced for significant future growth. Total addressable market, TAM, the total market opportunity available if the company captures its full potential. Growth investors assess whether the company's current revenue is a small fraction of a large and growing TAM, suggesting years of runway ahead. Here is the vault, the specific market environment where value always outperforms growth, and the one where growth always wins. And the reason most investors get this backwards. The variable that determines which style wins is not the quality of the companies. It is not the skill of the investor. It is interest rates. Why interest rates determine which style wins. Growth stocks are what analysts call long-duration assets. Their value is based on earnings expected far in the future, 5, 10, 20 years from now. To value those future earnings in today's dollars, investors discount them back using an interest rate. The higher the interest rate, the lower the present value of those future earnings. Every 1% rise in interest rates reduces the present value of earnings received 20 years from now by approximately 18 to 20%. Value stocks are short-duration assets. Their value is based on earnings they are generating right now, today. Rising interest rates barely affect the present value of current earnings, because the earnings are already in the present. This produces a predictable pattern. When interest rates are low and falling, growth wins. Future earnings are discounted at a low rate, meaning they are worth more in today's dollars. Investors pay high multiples for growth because the mathematical cost of waiting for future earnings is low. The 2010 to 2021 period with rates at historic lows, was the longest and most dramatic growth stock dominance in market history. The Magnificent Seven rose hundreds of percent. When interest rates are high and rising, value wins. Future earnings are discounted at a high rate, meaning they are worth less in today's dollars. Growth stocks fall as their future earnings become less valuable in present terms. Value stocks, generating real cash today, hold up better because their earnings are not discounted as severely. This is exactly what happened in 2022. The BOC and Fed raised rates aggressively. Growth stocks collapsed 30% to 70%, and value stocks significantly outperformed. The 2026 environment. Interest rates are at 2.25% in Canada, above the pandemic-era lows but well below the 2023 peak of 5%. This is a moderate rate environment where neither style has an overwhelming structural advantage. Growth has reasserted dominance in 2023 to 2026, driven by the AI spending cycle. But the elevated S&P 500 CAPE ratio of approximately 41.4 suggests that future returns for growth-heavy portfolios may be more modest than the recent past. Why most investors get this backwards? Investors buy growth stocks after a period of falling rates and strong growth performance, at the peak of the style's advantage. Then rates rise, growth underperforms, and they sell, locking in losses. They buy value stocks after a period of rising rates and strong value performance. Then rates fall, value underperforms, and they sell. The investor who chases style performance buys high and sells low within each style cycle. The classic mistake. The academic record on value versus growth is extensive and illuminating. The fameux French value premium. In 1992, Eugene Fama and Kenneth French published landmark research on stock market returns. Their finding? Over long periods of market history, from 1927 through their study period, value stocks, defined by low price-to-book ratios, outperformed growth stocks by approximately 3 to 5% annually. This became known as the value premium, the extra return investors historically earned for buying cheap, unloved companies. The Fama French research was so influential that Fama won the Nobel Prize in Economics in 2013. For decades, the value premium was considered one of the most robust findings in financial research. Then, 2007 to 2021 happened. For approximately 15 years, the longest stretch in modern market history, growth stocks dramatically outperformed value stocks. The Russell Growth Index outperformed the Russell Value Index by approximately 5 to 7% annually during this period. The value premium did not just disappear, it ran in reverse. Researchers debated whether it had been arbitraged away, whether it was a product of a specific historical period, or whether the structural shift to a lower-rate, higher-growth technology economy had permanently changed the relationship. Then, 2022. Value roared back. Rising rates devastated growth stocks and vindicated value investors who had been underperforming for a decade. The value premium reappeared, dramatically, in a single year. The honest conclusion from the data: both styles have worked over sufficiently long periods. Neither consistently dominates. The dominant cycles are long enough, 5 to 15 years, that investors who commit to one style and hold through underperformance are tested severely. The key insight from the historical record is not which style is better. It is that the winning style is almost always the one that has underperformed recently, and the losing style is almost always the one that has outperformed recently. GARP, the middle ground, Peter Lynch, the legendary Fidelity Magellan fund manager who averaged approximately 29% annual returns from 1977 to 1990. popularized growth at a reasonable price as the synthesis. GARP investors do not pay any price for growth. They do not avoid growth because current PE is high. They look for the intersection, growing businesses at valuations that do not fully price in the growth. The PAG ratio, below 1.0, is the GARP investor's primary signal. The growth versus value debate has been running for a century. Academic researchers, Nobel laureates, and the world's greatest investors have not definitively settled it. So what should the average Canadian investor actually do with this information? The honest answer for most Canadians: you do not need to choose. A broad, globally diversified ETF like XEQT holds both value and growth stocks across every sector, every country, every style. The TSX component is heavily value-tilted: financials, energy, materials. The U.S. component, through the S&P 500 allocation, is growth-tilted: technology, consumer discretionary. The international allocation provides further diversification across different economic environments. By holding XEQT, you already hold Shopify and Enbridge, both Constellation Software and Royal Bank, both Celestica and Fortis. You are not making a growth versus value bet. You are holding the whole market and capturing whichever style is winning at any given time. For investors who want to tilt, if you believe the AI infrastructure cycle will continue to drive growth outperformance, and you are comfortable with the higher valuation risk, adding a technology-focused ETF or increasing the S&P 500 weighting tilts toward growth. VFV, Vanguard S&P 500 ETF, is more growth-tilted than XEQT due to its pure U.S. concentration. If you believe interest rates will remain elevated or rise further, and you want the income and relative stability of value stocks, increasing the Canadian equity allocation, which is heavily value-tilted, or adding a dividend ETF like VDY or XDV tilts toward value. These hold the big six banks, Enbridge, Fortis, and other classic Canadian value names. The Canadian tax efficiency angle: Canadian eligible dividends, paid by value stocks like the Big Six banks and Enbridge, receive the dividend tax credit when held outside registered accounts. Inside a TFSA, they are completely tax-free. Growth stocks like Shopify generate primarily capital gains rather than dividends. Equally tax-efficient inside a TFSA, less so outside it. For the non-registered account, value stocks with eligible dividends are more tax-efficient than growth stocks generating capital gains at 50% inclusion. The temperament question: Warren Buffett has said that investing is simple but not easy, meaning the strategy is straightforward, but the psychology is difficult. This is particularly true in the growth versus value context. Value investing requires buying stocks that are unloved, that have been declining, that feel uncomfortable to own, and holding them while others dismiss them. Growth investing requires holding high multiple stocks through 30% to 50% drawdowns without selling, knowing that the thesis may take years to play out. Both require a specific psychological temperament. Before choosing a style tilt, be honest about which one you can actually execute under pressure. Let's come back to where we started. Shopify at 80 times earnings, Enbridge at 17 times earnings with a 7% yield. Two Canadian companies. Both have made long-term investors significant money. Now you understand why they trade at such different multiples. Shopify investors are paying for earnings expected 5 and 10 years from now, in a low-rate environment that makes those future earnings valuable in present terms, powered by the AI commerce infrastructure thesis. Enbridge investors are paying for earnings generated today: stable, contract-based pipeline cash flows that pay a 7% dividend whether the stock market is up or down. Neither is obviously wrong. Both reflect coherent investment philosophies with century-long intellectual traditions and academic support. The market environment determines which philosophy wins at any given time. Rising rates, value wins. Falling rates, growth wins. The investor who understands this and does not chase recent performance has the most durable edge. For most Canadians, XEQT holds both. The debate is settled by diversification. For those who want to tilt, the tool is knowing which environment you are in and which style it favors. The real difference between growth and value is not which one is better. It is which one you can hold through underperformance long enough for the cycle to turn in your favor.